governmental accounting lecture. So we're going to go over government. I'm basically going to go through the whole governmental story one more time. Basically, what is the idea with governments? What is the idea with governments? We're basically doing the allocation of limited resources to unlimited causes, right? There's no profit motive. There's no profit motive. So the governments are really operating. What's the main purpose of government? Spending the money. That's basically the purpose of governmental reporting, is to see if we're spending the money effectively or not, and if we have any waste and abuse. So who's looking out for waste and abuse? Young attorney generals are always trying to move up the legal chain by getting somebody off the corruption ladder, right? That's always the article. That's how you make it to who usually becomes governor in states? The attorney general, right? Because he got rid of a lot of corruption. But that's basically the idea, is what we're working with. And the GASB basically talks about the reports are going to legislative bodies, to citizens, to investors and creditors. And the key thing about governmental accounting is how many sets of financials do we have? Two. Two, because it's government-wide financials and fund financials. They're so totally different. They're not even, I don't know if you guys know, but like in a way, like insurers, anybody, like if you work in insurance, they keep two sets of books internally. One is cash basis and one is accrual basis. It's same thing with government. Like they keep two sets of books. One is governmental wide and one is fund specific. The different activities, every activity has like a fund, basically. You know what I mean? You could have like your fund for running a highway, or you could have a fund for running a cafeteria, a fund for running a pension, or you could have the general fund that just runs the government. So what is the difference between fund financial statements and government-wide financial statements? In a way, fund is specific. It's always the very specific, like Peter was saying. It's really can be so nuanced relating to just the highway. Like, as opposed to government-wide, you're really talking about the entire complex, the entire New York public school system, all of Rutgers, all of New Jersey State, or all of the federal government, right? So in a way, they're completely different things. They're not even the same thing. And some of the highlights: restrictions on the use of resources. In the equity section of the fund financial statements, there will be 5 characters to the use of the equity, right? This equity will be restricted in 5 ways. We'll go over it more in a little bit. And then they go only into that specific activity, only just one specific activity. And the whole purpose is to assess in how efficiently you're able to execute the job of this fund. So, and in a way, if you're an experienced financial analyst, it's so easy to see where is the waste or abuse by looking, if I give you 2 years worth of data on how Rutgers has been operating, on every activity, how would you notice the waste and abuse? Isn't it so easy if I show you the finance department, accounting department, or marketing, and their revenues and costs? How quickly would you be able to see which department is the loser? In a way, you would be right away see this one is not publishing as much research, or they're not generating as much tuition revenue, because they're not, you know what I mean? Because the comparative financial statements really reveal the difference. So that's basically the same thing, just for specific funds. And this focuses on the revenues and cost on a long-term focus. This is more looking at like, can Newark as a city generate a bond, generate a capital inflow from Wall Street to build a light rail? Can Newark as a city show enough health in its balance sheet to go to Goldman Sachs and say, listen, we need $800 million, we're building a new light rail over here at the Broad Street. We can pay you back. the intention is more to generate capital financing, as opposed to the intention here is to assess the quality of the activities. So you see, like, the whole purpose is very different here. So in the fund financial statements, it's interesting because in the fund financial statements is basically what you'll notice on the balance sheet is just very short-term assets. Just cash, receivables, and short-term marketable investments. You're not going to see anything else. Because in the fund world, any capital asset that you buy is actually an expense. For example, if I have a fund, to run technology at Rutgers, for example, the technology service fund. And I bought a bunch of service for a new computer lab. All the service would be expensed. They wouldn't be capitalized. As in GAAP, servers would get capitalized, right? In the fund world, servers get expensed. Why? Because in the fund world, we're just looking to see what? Not profit or loss, which is in the business world, you capitalize an expense to achieve a matching principle, which matches up your revenues and expenses. In the fund world, I'm just curious, how much money have you spent? How much money have you spent? And did you spend more than last year? Right? We're always curious. It really comes down to, like, did you spend more than last year? Right? And why do they always spend everything? You're not going to give it back, right? That's silly. And you're not going to get more if you spend less. What happens in business if you spend less? No, in business. If you spend less, you should get a bonus. Right? And EY always, like, when I saved money, they were like, oh, we'll hit you up with a 500, whatever. Never did, actually, but in the mail, it's in the mail. But in other ways, happy hour, oh, go out. But in a way, like, you do get reimbursed, I think, in businesses, like, eventually, if you make it high up enough, if you save money, they'll give you, it's supposed to give you a bonus, right? At least they get a bonus for sure, owners. But in government, it's the reverse. Like, if you don't spend the money, actually they're like, oh, wonderful, we'll just give you less. You should fire some people and we'll give you less. So you always kind of spend the same amount or more, and you substantiate it, right? That's like a nature of budgeting, and we'll go over what is budgeting. What is budgeting? And then, the key thing about fund accounting is the method of accounting is modified accrual accounting. What's modified accrual accounting? It's basically saying instead of accruing when an event occurs, right? What is accrual accounting in general? You match it, you recognize something when it becomes apparent. Not when you receive the cash, but when you realize that you might receive the cash. It's basically more based on expectations rather than actualities, right? So modified accrual accounting, it's a subtle difference, but it's very important. It's kind of like, I'll give you an example. Property tax. Say you're a house owner, and as soon as the year ended, I basically tell you, you owe me the property tax for this year. Say it's $14,000. So I'm gonna basically record a receivable for $14,000. Not that I even sent you an invoice and not that you're even intending on paying that, but I am already extending that accrual on my books. 9 times out of 10, people will send me the check in just a few months. But the modified accrual is just saying that I have legal attachment to the cause of receiving this money. So modified accrual is like accruing based on legal ability to get access. So this, notice, governmental wide financial statements, accrual accounting, big picture, showing all the services. The whole intention is to get financing to show a bank the health of the entire government, right? And assess operational accountability. So the whole report is geared toward essentially a presentation for like a Moody's or an S&P. And if you look, guys, when I used to work at structured finance, I used to work securitizing CDOs. I used to work basically for Moody's and S&P were like the people that were on us for like all the reports. We would issue our reports to Moody's and S&Ps, basically indicating the health of the prospectus of the deal in terms of what EY thought in terms of quality of the modeling. So it was a lot of fun. Great times back then. A lot of late sushi dinners, but basically, what was the idea? I was working in assessing credit quality. So I thought back then, I was like 24, 25. I thought that I spent a year or two doing this. Back then, whoever managed to stay alive in that department for over a year or two ended up working for a hedge fund, making like $250,000. So I thought I'm on like a great track there until 08 happened. And in about like over a course of a month, our whole department got liquidated because we were like in the epicenter of the financial crisis. We were like, you guys have made the most illiquid product that is like blowing up the world economy. And like our department basically they like stopped doing whatever we were doing. But anyway, I learned a lot in terms of like credit quality, and I learned a lot about the governmental commercial market, and I learned that basically the most liquid and the most broad financial market is the municipal bond market. And that's basically what we're talking about, like the financing for all the power system, sewer system, and water systems on the local government level was basically the most voluminous capital market for fixed income in our country and in the world. In a way, because it's secure and because it's so wide. And it was called back then commercial paper. And I saw this commercial paper in a lot of the deals because everybody loved parking money in commercial paper. Like banks, what we used to do is we used to work with banks, and while we're structuring this deal, it was always $1 billion deal. While we're structuring the deal, they would have this cash, we called it was $1 billion. And they would put the cash, what they called a warehouse. The bank would front the money. And so they'd have $1 billion in cash, they would have it around for 3 months, and they would kind of park it in these municipal bond assets, short-term assets. And a lot of companies do it. If you look on corporations' balance sheets, this is the most popular short-term investments, is sort of these type of governments. And that's why they're able to finance so many capital projects. Anybody know what's going on now with the infrastructure market in terms of highways, sewer systems, bridges in the country? A lot of repairs. What else? New construction. Huge investment into infrastructure in our country, right? They're revitalizing all the bridges, all the tunnels, all the systems and everything like that. So that's where a lot of the huge amounts of money is going. So that's a lot of investment there. Basically, in charge by this nexus of entities. So basically, this is the distinction. I think just like we had in Chapter 10, that one table with all the rates, that was really important. I think in this realm, this is the table that's really important, is really the separation of the two by each character. And you know, you have your accrual versus modified accrual, overall financial health versus inflows and outflows of financial resources. Now with funds, it's important to know, with a fund, I have revenues and expenses for sure. But what's the third aspect that controls operations? What's the third aspect? Yeah, Maria, right? Like commitments in terms of expenditures? Encumbrances, but that's like sort of how you deal with allocations of monies. But I'm talking about, for example, with the Newark cafeteria. They were not self-sustaining. So something happened there to equalize that, right? And now I'm curious about that transfer. Basically, exactly, the funds that are not self-sustaining are getting transfers from, sister, brother, parent type funds. And in this situation, who helped them out? Basically, the general fund. The general fund and the character, if the income was federal program to support the lunch and breakfast program. But in a way, money that essentially came to Newark from the federal government, came to New Jersey from the federal government, New Jersey to Newark, and eventually into this fund. So this is a big part of the fund world. It's the inflows and outflows of supporting funds to compensate for expenses. So basically, we have governmental funds, proprietary funds, and fiduciary funds, and we talked about this to a degree already. And basically, governmental funds actually provide the service to the citizens. This is anytime, think about it, anything that you get as a society, as a citizen, from the government, you're probably interacting. If it's direct, it's a governmental fund. Proprietary funds, I think, is really easy. It's basically what is an example of a proprietary fund? Fannie and Freddie for yeah. In a way, they do proprietary type work. Because Fannie and Freddie, they do really interesting work. They're very creative. I used to have such a love for them. Anybody know what they do over there? These entities are charged by the government they were created to promote home ownership. Let's start with the beginning. They were basically senators created this idea that it's better for people to be homeowners than renters. So they promoted the idea of having home ownership. So they created these governmental, semi-governmental entities, semi-not, and they basically they lowered what they were doing back in the day was they were, if you know how back in the day you were supposed to put 20% down to get a house? This was before everything, like in mid-90s. And the reason, and I think back then before that, you couldn't even really do that. You couldn't get a home if you put 20% down, or the interest rate would still be high. So initially, I think in the late 80s, Fannie and Freddie were doing actually something really awesome, which they came in and said, if you're going to put 20% down on a loan, we're going to guarantee it. And we're going to send it off to the bank with that piece of not a piece of insurance. What they would do is, if the bank originates the loan, then they would buy it from the bank. Basically, all loans became either Fannie approved or Fannie not approved back in the early 90s, from what I know. I don't know much before that. But basically, what happened is that banks started originating more loans because they said, you know what? If we put this thing through, if it's 20% down loan, Fannie will take it off your books like that. So it created this whole environment of, in a way, the whole idea that origination and maintenance of the loan is two separate things. In a way, the origination is one thing, and maintenance is going to be Freddie's problem or Fannie's problem because they're going to sell it off. So all they had to do is originate the loan, and that's sort of what started. And then Fannie and Freddie, what they did was back then, really awesome idea, by the way, early 90s, they started the securitization market by themselves. They started the securitization market because then Fannie and Freddie, what they did was they took all these high-quality, super high-quality mortgages, 20% down mortgages, super high-quality credit, and they worked back then with the first banks to come up with the first securitized product, which is if you put a lot of good loans in a basket, that product in itself becomes a really high-quality product. And that was the first idea of securitization. And that was a good idea because what happened was that people loved it. People loved it because it was very high quality, reliable credit. And the thing is, the whole arbitrage was that why would I buy a treasury security that yields 3% if I can get this Fannie paper that pays 4%? And now you're talking to a Chinese sovereign wealth fund manager that's holding $800 billion. And this guy, and you're talking to this guy, and this guy was like, well, listen, I have $200 billion, so a percent on $200 billion is a lot. $2 billion. And we'll know what to do with that. So basically the idea is they were like such attractive product because these Asian and Middle Eastern funds and loved it. Japanese sovereign, all these people who had to park dollars, they loved it and it made sense. And what happened was that they just wanted so much more of it. And that's sort of the picture I was at, I guess, 10 years later, was that we were cranking these things out by the dozen of whatever. By the time I got there, there was no quality whatsoever. They forget the down payment, basically no income, no money down, Arizona, Florida high-riser. I don't even know if I showed up to the loan closing, but I got the loan somehow. But basically, we're securitizing that. Countrywide went out of business because it was just became this disassociation between the vehicles and the maintenance. And basically, the idea was that Fannie Mae and Freddie Mac, they were purchasing these loans. But then in a way, they took them out of the equation. They always said, we don't want that. Super. Yeah, they were approving them. They were basically they weren't disapproving them, basically. You know what I mean? In a way, they took them out of the equation because the banks would go straight to the countrywides. Basically, there was no Freddie Mac or Freddie Mae if we could cut a securitization deal and just cut up the whole thing without the involvement of a Fannie Mae guarantee. Anyway, it got pretty complicated. But that was basically, like a big part of the credit market. But I think, in a way, I saw it from a different side because I think a lot of people always talk about the crisis in terms of all the fraud on the retail level with the lack of approving good loans. I saw it more on a really interesting side on the demand for money level. I saw more the pool from Asian investors for dollars and why there was so much pressure on people to issue loans because all these Asian investors were ready to put in all this money, and this money was waiting to enter the U.S. and they needed somewhere to park it at, other than U.S. Treasuries. So more on a different side of where the power came from, in a way, because of course fraud is always going to be fraud, but there's got to be a demand on the other side of the fraud. Go over just some notes I made here about what is some of the restrictions that we talked about in terms of fund balances. What are the restrictions? And basically the restrictions on the bottom there in fund balances, restricted means it's already been allocated to be used for something, to be expended on something, right? And fund balance committed means, and guys, in a way, I want you guys to not use the laptop for this exercise, the specific one, just this one, because there's one idea. Yeah, I was talking in the other class. It's not that I don't want you guys. I usually love laptops, but we had in the summer a lot of creativity regarding exams and technology, and sometimes the creativity just expands rapidly throughout the room, and it gets extremely creative. So in a way, so I don't get very creative emails later from other people who don't have laptops, that we can just, for now, just for the purpose of this exercise, just use your pen and pencil, more traditional, and by that I mean to go like this. Yeah. So, what I'm talking about in a way, so yeah guys, so we'll work with that, and what I mean, so there's 5 types of these commitments. So this committed means that we're already committing it to something. And in a way, like that means we already decided what to spend the money on. Assigned means a manager just said, oh, in my opinion, we should do that. So it's just a suggestion. And unassigned means it's free, that it's like available, for any use, right? So what is the idea of budgets, guys? Who can explain to me in the governmental context, what is the use of a budget? Like, what would you use a budget for? The plan for your expenditures, right? So basically, in a way, it's also to put your policy into effectiveness. Like, how do you basically make your policy alive? Aren't governments essentially allocating funds to different programs? So basically, the budget is the effective legal execution of your policy. Because you're saying to your government, this is how I'm going to deploy my funds this year. So it's an execution, it's the expression of policy. It's the intention for the upcoming year. And it provides control because it basically sets different limits at different points for the use of funds, right? So you're basically communicating to the world and saying, this is what I'm going to do, this is what I'm not going to do, right? Don't they have issues voting on budget sometimes? Right? Because the issue is like the contention of what you should use the money for. Is it to reform education, or is it to reform healthcare, or to reduce student loan interest rates? So offer a means of evaluation. So basically, we have California. I don't want to get into it, but if your curiosity piques, then you can look at the California state budget here. So we have allocation. So encumbrance accounting, I want to go next, and I think that shows up in your little handout also. Encumbrance accounting. Anybody know what encumbrance accounting is? Anybody encounter that before? Encumbrance accounting? It's basically when you set money aside in advance of something that you're going to do. So say I have a research assistant, and I'm in a government fund. Before I even hire them, I would say I'm encumbering $40,000 because I know that's their salary. So I would debit encumbrance, credit voucher payable. Then I get the research assistant and I pay the salary. I credit out the encumbrance to cancel it out and debit salary expense. So what is it? What is encumbrance in a way? What is encumbrance? What's the purpose of encumbrance? Claiming the funds. It's like allocating the funds before you even have you know what I mean? It's like the intention to put the funds to use before you even do that. Why do we do that? Jesse, why do you think we do that? Like, why do we allocate funds like this in a governmental setting? So what about capital assets? So capital assets, in a way, we don't have, as I said, in funds, they only show up as expenses, and they don't show up as capital assets, because funds only show short-term assets like cash, receivables, and investments. So basically, we only focus in funds on short-term assets, and everything else is an expense. Again, because we want to see how the money was used, we're not so focused on presenting an accurate picture of a balance sheet. We're more focused on expenditures. And then we want to go over into this idea of prepaid assets. Another nuanced difference between governmental and GAAP accounting. We have purchase method, which recognizes the entire expenditure on supplies as an expense, and at year-end recognizes the asset that is left. So in a way, with the purchase method, when you buy something, you first expense the whole thing, right? And then at year-end, say you have a piece of supplies left, then you record that as an asset. Right? So it's basically the idea of how to work with this piece. As opposed to That's the purchase method. The consumption method records the supplies and then reduces it as it goes along. As it goes along, it reduces that piece. So that's a nuanced difference. So we're going to look at revenue, and then we're going to look at some examples. So what about revenue? What about revenue? Types of revenue. So where does revenue primarily come from? What kind of taxes are we talking about? Property, sales. There's taxes. Basically, the government money is from like derived taxes, which is income tax and sales tax, because they compute this based on a transaction or an income. It's derived. And then there's I love this one. Imposed non-exchange. It's basically imposed as property taxes when they basically force you to pay, taxes on your property. Anyway, but that's how they generate. I think they generate revenue like that in the city, because they just fine you for everything, essentially. And then there's governmental mandated non-exchange transactions. This is more like grants from one government to another, but this is mandated. So this is basically like saying New Jersey is mandated to give Newark school system the $1 billion funding. That's mandated in a way by the New Jersey laws. And then voluntary non-exchange transactions is donations from individuals, other governments, or organizations. So voluntary, in a way, Rutgers, once we look at Rutgers next week, you'll see that Rutgers, half its money actually, tremendous amounts of money, outside of state and tuition, actually come from governmental foundations and private foundations, kind of like the Bill and Melinda Foundation, these semi-private foundations, $400 million a year, I believe, because they are looking to promote science. And Rutgers, and in terms of what we do upstairs, part of the team, is we're constantly issuing requests to foundations to sponsor our scientific efforts. And that basically throughout, not just RBS, the whole university, and very successfully raise money from these foundations based on all these proposals that are constantly being generated to fund scientific research. And in a way, that's basically what each department does with their PhD population, is basically get funding to just publish research. And then we publish that in the journals. So that's basically all voluntary, but this is like, could be a huge amount of money as well. You'll see, like, this is also a significant part of revenue. Financials themselves. Let's see here. This is basically the governmental wide statements. You have your statement of net position, which is this. And we have a statement of activities, which is this. So just so you get a flavor, there's really two statements. One is like a balance sheet, and the other one is like an income statement with a statement of changes in equity embedded into it, right? And here you see that there's restriction for the equity. That's the main thing I want you guys to focus on, is the restriction for the equity. Notice supplies, they would be worked by either the purchase method or the consumption method. So notice that there. And notice that you have capital assets here, but you wouldn't have capital assets on the fund financials, because capital assets are expensed on the fund, but deferred on the government wide. So you want to just notice that. In the statement of activities, you see that basically you have expenses by government activities, business activities, and you have each program revenues and expenses. So you really see how the whole government is doing. And then, boom, revenues. Revenues according to the 3-4 types we talked about: taxes, investment earnings, and transfers in and out. Right? So we have that, and then we have the change in net assets. So it really shows you the whole structure here. And then fund financial statements, you see the fund financial statements, we have a balance sheet, and then a statement of revenues, expenditures, and other changes in fund balance. I think this other one is what I want you guys to focus on. This is how funds essentially get funded. Because funds are not going to be always revenue funds. Sometimes they're going to be purely expenditure-like funds. So they're going to use a transfer from another place in order to fund it, right? And this is the fund financial statements. This is the fund financial statements. And notice the big thing here, the liquid assets only on top, no capital assets on top, as we saw, right? Only liquid assets up here. Notice that capital assets were expensed throughout the year. Notice that the net equity is allocated according to liquidity. Non-spendable, restricted, committed, assigned, and unassigned. So the net equity is assigned according to the freedom of its use, from the least free to the more free. And you want to just understand like that hierarchy of the freedom of use of funds. And this is the statement of revenues, expenditures, and changes in fund balances. And this basically, what I want to show here is that we have our revenue by the several types. We have the expenditures here. And then we have transfers in and out. Notice that transfer in and out, it's very different than anything we've ever done in GAAP, right? Has anybody ever seen anything like this in GAAP? Other financing sources of use? It was like the use of financing in the cash flow statement, because when you get financing, in a way, you're absorbing financing or you're distributing financing. And the cash flow basically shows you how you're utilizing funds that are not yours, like either a capital raising or a bond raising, or a distribution like a dividend. And in a way, it's external money that's now become internal, right? So basically, you have a little bit of the cash flow aspect embedded into this fund statement. With budgeting, just, in a way, also a really big piece here. And I wanted to ask you guys the question, how do, in even governments, but even corporates, people use budgets? How do people use budgets to generate efficiency? We look at last year's expenditure. Say last year we did the same thing, and it cost $4,500. So this year we're saying $5,000 because we're going to have a little bit more technology. So right away we know that we're in a way. We know why it's $5,000 because we always go off of last year to next year, right? But we have to modify for any new staff, any new expenditures, any new things going on. I remember in audit, I used to do budgeting as like a manager on audits. And basically, every time we did the budget, the easiest thing to do was to take last year's budget and don't change it. But then you get ripped by the manager above you. Be like, oh, look at all this thing. We have new staff. We're in a different location. We're using different technology. They have controls now. Like, we didn't do anything. So that was like, but no way. Like, you have to really think, like, what is going on this year that's different? Like, we might have new people, a totally different approach. We're using different procedures. You want to basically really see what you're doing and how you're allocating it. Because in a way, I think profit is driven by the ability to meet budget. And I think like military, in a way, it's not necessarily about profit, but in a way with departments, it's about hitting the closeness to budget. I remember in audit, the biggest deal was when you were off budget. In a way, sometimes I was in the manager role. And in that role, part of your responsibility in a way is to not necessarily, they didn't really care if you're over or under budget so much as long as you communicated that very early on. The biggest trouble you get into is when you don't communicate that you're over budget way in advance. Because then they're very surprised that we're not making money on this engagement because we didn't make the modifications throughout the year. So they want you to get in there with a budget, know exactly where you're at, and update that budget as you go along so that halfway through, you can make some executive decisions to still hit your profit target. So kind of like, in a way, budgeting allows you to keep awareness of your ability to stay on profit target. And I can't tell you how important it is to people in the upper levels because in a way, they get in trouble if they don't hit profit. And in a way, it's because we were not paying attention to the budget or how we're using the budget. And that sort of is a really key thing because it's basically a tracking tool to stay aware. And then I remember when I would hit early on, we're over budget, we're over every meeting, I would say, we're over budget, we're over budget, we're over budget. And in a way, by the end of the engagement, I wouldn't get in trouble at all. Because I was like, oh, no, I was telling you over budget from day one. We're cool. And they would be like, in a way, we're like, okay, we're just going to charge them the extra 50 grand. It's not your fault. And you have to really make that awareness clear so it doesn't come back to you. In a way, I think with governments and nonprofits or military, it's like, in a way, like, same thing. Because in a way, if you don't spend your money as a government, then they'll take your budget away. So I think the best approach, I think university or like military or like government, they would basically spend their money really wisely and show tangible results of what they're using the budget for, and then request more next year or the same. In a way, at Rutgers, I know in a way, like say we're drawing a lot of budget in the Accounting Information System Department, we're also saying, yeah, we're drawing a lot of budget, but look, we're also increasing the number of enrollments, the number of student placements, the number of placements in the top journals in the US for published research, and rankings for different business rankings for our program. So in a way, it's like, yeah, we're drawing more budget, but we're deploying these resources in really wise ways, in really energetic, wise ways. So we want even more money, or at least the same money, or whatever, from the president. So I think it's like how you look at it, and I think it's a really good tool to really work with. So two more minutes. We'll talk about a few journal entries I just wanted to go over. This is basically how you allocate the budget. In a way, like you basically show your revenue, and then you kind of like hit appropriations to each part of the expenditure. So this is a budget entry. And then this is the flow of transactions, in a way, in a government environment. You start with a budget, which is basically a map of what's going to be happening, and then you start to encumber money, and then you spend it. How do you encumber money? What we talked about, you encumber money for ammunition, for example. You basically put a lien on the budget for what you need, or you put a lien for like, say, professor salaries. Like first, we would do salaries, building maintenance, utilities, and healthcare, whatever, like the top things first. Then you might have money left over, special projects, whatever. Say we want to teach in Shanghai, like they used to do for a while. So we're going to do the China MBA. But that's basically something that's additional. You know, we're going to create a new program, Macy program. That's like an additional piece that will come in. Given that you encumbered everything already, now you have a little bit left. And that's the flow of transactions before you're spending money.